No, gold always goes up before a recession. The
Oh, okay.
the secular bull and the secular bull market will continue in gold, and I think it will peak out at $6,000 an ounce. It broke 3,900 this week. Hit a new all time high, and as we speak, even today now, October 2nd, 2025, we can just state what I'm going to look at. Yeah, we got gold. It's down a little bit, $47 today, but it's still 3,850.
SteveHanke sees gold not just as a commodity, but as a crucial form of monetary insurance in an increasingly unstable global financial system. He believes that when central banks flood the system with liquidity, especially in response to crises or economic slowdowns, they erode the value of fiat currencies. In such an environment, gold acts as a counterbalance, a tangible asset that holds its value over time. Hanke views gold as a rational response to long-term monetary mismanagement and believes it plays a stabilizing role when trust in central banks begins to fray. This perspective is grounded in history, where gold has repeatedly served as a reliable store of value during periods of monetary excess or geopolitical risk. A major part of Hanke's analysis focuses on the actions of central banks themselves, particularly in countries like China, Russia, and India. He notes that these nations have been steadily increasing their gold reserves over the past decade, not necessarily as speculation, but as a strategy to reduce their exposure to the US dollar. Hanke interprets this shift as a structural move away from a unipolar, dollar-dominated financial order toward one that includes gold as a reserve anchor. He sees these central banks hedging against Western sanctions and potential instability in global payment systems. Their accumulation of gold isn't about short-term price speculation, but about securing financial sovereignty. Hanke believes we are currently in what he describes as the eastern phase of a gold bull market, driven largely by demand in China and other parts of Asia. However, he argues that a more powerful second phase will begin when Western institutional investors and portfolio managers begin to meaningfully increase their gold allocations. In his view, Western investors have so far been underweight gold, focusing instead on equities and tech-driven narratives. When this shifts, either due to inflation, recession risks, or geopolitical uncertainty, the combined demand from East and West will accelerate gold's upward trajectory. He sees this inflection point as critical for a sustained move higher in gold prices. Now, we present the clips from Steve's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
No, gold always goes up before a recession.
Oh, okay.
The secular bull and the secular bull market will continue in gold, and I think it will peak out at $6,000 an ounce. It broke 3,900 this week. Hit a new all time high. And as we speak, even today now, October 2nd, 2025, we can just state what I'm going to look at. Yeah, we got gold. It's down a little bit, $47 today, but it's still 3,850. When I say what's happening today, that's what's happening with the nominal GDP, for example. And that has a real component and an inflation component. So if you add real growth, inflation, you get the nominal GDP number. And that's all driven by what's been going on with the money supply some time ago. And in the past, you don't see it today. You've got to look at the past data to get a handle on that. So that's the main thing. You've got to have your bearings on the quantity theory of money. The economy is all driven by the fuel in the economy, and that's the money supply. What's going on with that? But beyond that, there are a couple of things that really people should be paying attention to, and they're usually completely confused by the few things that they should be looking at. Most people look at what's going on with gross domestic product. That's the value of final goods and services that are sold in the economy. And the
Mm-hmm.
second quarter GDP numbers, by the way, everybody was all excited about them. The growth rate was 3.8% year over year growth. So it was higher than people expected. And so everyone got agitated. The economy is booming along and doing very well. I like to look at gross output, and gross output is quite different than conceptually quite different than GDP, because GDP, as I said, is the value of final goods and services sold in the
Mm-hmm.
economy. Final. Now,
Mm-hmm.
the intermediate transactions that take place in the economy are picked up by gross output. That's everything in the supply chain. We've all gotten used to talking. Everybody understands what a supply chain is now since COVID. That's
Yep.
when everybody learned about that. So if you're manufacturing an automobile, for example, the value of the automobile coming off the assembly line, that goes into GDP. But before that, there are lots of transactions going on. The manufacturer is buying tires, buying nuts, screws, carburetors, steel, God only knows what. And all those transactions taking place are added up and accounted for in gross output. So if you look at gross output, it's a little over twice as big as GDP. GDP in the United States is about $30 trillion, and gross output is about 63 trillion. So what's been going on? I said GDP second quarter growth, 3.8% year over year. Gross output was only growing at 1.2%. That didn't surprise me because since April of 2022, the money supply actually until this summer, it had actually been contracting. The stock of money was going down. And when that happens, we always end up with a recession. Now it's picked up a little bit, and it's growing at about 4.8%, measured by M2 year over year, and that is still tight and slow and anemic. The growth rate consistent with hitting the inflation target of 2% in the United States is Hanke's golden growth rate, which is about 6%. So it's the growth in the money supply. It's coming up a little bit, but it's still pretty anemic. So this gross output number being a lot less than half the rate of growth in GDP doesn't surprise me at all. Now, there's another thing that, and this is something people should get in their head. If they remember when they took principles of economics, and all economists, all economics textbooks, are all Keynesian books, and they all talk about the economy is driven by consumption. Consumption accounts for about 2/3 of GDP. Is C plus I plus G plus the net exports is equal to GDP, and C is 66% of that number. And if you read the press, 100% of the press, it's always consumption's driving the economy. Well, it is true that consumption accounts for 66% of GDP, but it only accounts for 33% of gross output. So it isn't the big elephant in the room. Consumption is not.
One of Hanke's more notable projections is that gold could eventually reach $6,000 per ounce before the current bull market ends. This is not a short-term prediction, but a long-cycle estimate, based on the assumption that the U.S. Federal Reserve will eventually lose its ability to contain inflation without triggering severe economic damage. He sees structural forces, such as unsustainable debt, entitlement obligations, and declining faith in the dollar, as setting the stage for a repricing of gold over several years. While many analysts expect modest gains, Hanke's outlook is more aggressive, reflecting his belief that systemic pressures are building and that gold will respond strongly when confidence in traditional assets begins to erode. Despite this bullish stance, Hanke is careful to distance himself from the gold bug label. He does not see gold as a replacement for currency or advocate for a return to the gold standard, but rather as a highly useful hedge in times of systemic uncertainty. What makes gold especially appealing to him is its lack of counterparty risk. Unlike stocks, bonds, or even cash in the bank, gold doesn't depend on another party's promise to maintain its value. That makes it uniquely attractive during periods of institutional stress, when confidence in governments or financial institutions may falter. For Hanke, gold's appeal lies in its autonomy and resilience, not in any romantic or ideological attachment. Let's get back to the interview.
It's slowing down. Supply chain activity is a lot for the final GDP number, which means that the final GDP is going to be slowing down. The second quarter GDP was 3.8%, and the second quarter number, gross output, was 1.2%. And by the way, if you adjust go and you add wholesale and retail sales to go, that's the adjusted go, that was only growing at 0.3%. So if you look at all the transactions in the economy and add them up, that was even growing more slowly than gross output. So what the story is, if you look at that top line number, GDP, it looks like everything is great. You look under the hood of what's really going on in the economy, all the transactions taking place. You add all the transactions up, and way down. It's growing hardly at all. And eventually that will show up with a slower. Yes.
Interesting.
And then we flip over to the demand side. We move from the supply side, this gross output thing, and we look at the final sales to domestic purchasers where you adjust GDP. You clean it up, and you get changes in inventory and changes in net exports out of the picture. And once GDP is cleaned up and you look at the value of final goods and services that are actually being sold to the public, that number is slowing too. It had been running for 2 quarters at about 3%, and now it's down 2.3%. So that's telling picture.
Go ahead. Yeah, I'm also pulling up the PPI, and it looks like that's slowing down as well.
Right, and that comes before the consumer price index. The consumer price index is for things that are final goods and services sold. The PPI is these inputs into the supply chain. Whatever the big changes are in the money supply that happen will eventually, with a lag, feed through into economic activity and inflation. And now the question is, well, what data do you look at today to get some handle on what the money supply changes a year ago or 2 years ago are driving? And I think gross output is something people ignore. It's very important, but they just look at GDP. And almost no sophisticated people look at final sales to domestic users. More so. But you don't read paper, by the way. It does not feed through. Read the press. How many press reports and what kind of narrative are we getting about final sales to domestic purchasers? Zero. Gross output, almost zero. Now, when you look at prices, how many times do they really get on producer price index? You just put up the producer price index there. How many times do you see that in the newspaper? Almost
very rarely.
You never see it.
Very seldom.
You have to have an economic macroeconomic model, and the only reliable one is a quantity theory of money. Articulated in a current book is a book I wrote with Matt Sekurki called "Making Money Work." It's all laid out in Sekurki and Hanke, Making Money Work. Wiley just published that in May, so it's hot off the press and doing very well. But so you have a model, a macroeconomic model. It's reliable, been around since the 16th century. That's one step, and then the next step is, well, if you're looking at current data coming out, what data should you actually be focused on? And on the supply side, I think gross output is what you should look at, more so than GDP. It's much more telling and accurate measure of what's really going on in the economy. And final sales to domestic purchasers is the proxy for aggregate demand in the economy. So you got the supply side at macro picture with gross output, and you've got the demand side aggregate proxy with final sales to domestic purchasers. So you're looking at three things: changes in the money supply, changes in gross output, and changes in final sales to domestic purchasers. Now, the change in the money supply, of course, that's relevant is back before today. It's before October 2nd. You're looking back, you'd be looking at April 2022 month supply, because that's when things started contracting, and that's what's driving the numbers that we're looking at for gross output and final sales to domestic purchasers of today, October 2nd, 2025.
While optimistic about gold's long-term potential, Hanke acknowledges the uncertainties involved, particularly in the short term. He points out that if central banks manage to maintain tight control over inflation and successfully navigate economic challenges, the urgency to buy gold could diminish. Additionally, markets are inherently unpredictable, and investor sentiment can shift quickly based on news or policy moves. Therefore, he cautions that gold's path upward may be uneven, with corrections and pauses along the way. Still, he remains confident that over the next several years, the forces driving gold higher will outweigh the headwinds, making it one of the more compelling assets for investors concerned with preserving value. The effect would not simply be a price rally, but a structural revaluation that repositions gold and silver as core safe havens in an era of deep uncertainty. Looking forward, the future trajectory for these metals appears asymmetrical, with limited downside and outsized upside. Should confidence in traditional markets falter, capital inflows could arrive in waves, driving silver to levels that challenge historical benchmarks and propelling gold into territory that redefines its role in global finance. This would not unfold as a gradual climb, but more as a sudden repricing event once liquidity begins to migrate en masse. The sheer scale of money poised to move suggests that the impact will be both rapid and far-reaching, reshaping how investors, institutions, and nations view hard assets in the years ahead. Share your thoughts on experts' analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.